Hey everybody, welcome back. It's Doug DeBruyn with New American Funding. Today I thought I'd talk about TLAs. A TLA simply stands for a three-letter acronym, thus the TLA. As you start your journey down the home buying process, you're going to hear a multitude of TLAs as you go out throughout the process. So I'm going to go over a few of them that you're going to hear, hopefully shed some light on what they mean, help you to understand them as you're going through the process from start to finish. So without further ado, today's first TLA is LTV. And that simply stands for the loan to value. So if you have a $100,000 house with an $80,000 loan, you have a LTV or loan to value of 80%. It's simply the ratio of the loan amount compared to the value of the house. So that's LTV. That's our first TLA for the day. Next LTV you'll probably hear is DTI. That stands for debt to income ratio. Basically, we're going to take all your debts that are on your credit report, the minimum monthly payments on those debts. We're going to add that to your housing payment, which could be the mortgage, property taxes, property insurance, any mortgage insurance, any HOAs, that type of stuff. We're going to divide that in to your gross income for the month, and that's going to be your debt to income ratio. Let's say you have a monthly income of $10,000 gross. Keep it nice round numbers. $10,000 gross for monthly income. You have a couple car payments, maybe a credit card payment on your credit report. Let's say that's $2,000 a month of debt you have to pay. And let's say the housing payment all in is $3,000 a month. You have $5,000 of debt to $10,000 of income. Your debt to income ratio is 50%. So that's how we figure that. And that's a key ratio when we're doing underwriting. So we definitely want to keep that under 50. In the low 40s, upper 30s is preferable. But every loan program is different, and it changes, the multiple ways depending on credit score, income, reserves. There's a lot of other factors that go into it, but that's your debt to income ratio, or DTI. Next one is not a TLA, but it's a term you're going to hear bandied about. It's called points, or paying a point. Basically, a point in conjunction with locking in the interest rate or getting an interest rate quote. Maybe, hey, we'll give you 6% at 2 points. We'll give you 6.5% at 1 point, or we'll do 7% at no points. A point is simply 1% of the loan amount. So if your loan amount's $500,000, 1 point is $5,000. 1/2 a point, $2,500. 2 points, $10,000. So that's basically points. And points allow you to just pay some money up front to buy the interest rate down a bit, or depending on credit score, again, depending on a lot of other factors, your loan could be priced at a point just off the get-go, or 1.5, and that could be the top of that loan officer's rate sheet. Like, all I got's 7% at 2 points for you. So it varies wildly. It doesn't stay the same every day. It changes all the time. But for our discussion here, a point is simply 1% of the loan amount. The next number or TLA you may hear bandied about is 1003, or IRLA. And that simply stands for the loan application. That's the loan application form. It's called a 1003 form. It's also abbreviated as Uniform Residential Loan Application, or IRLA. So that's that TLA. Next one you may hear, it's only a 2-letter acronym. It's MI, mortgage insurance. So if you're not putting 20% down on the house, you're going to have some sort of mortgage insurance. We have a bunch of verifications. Usually the processor or underwriter takes care of this for you, but you may hear these terms like, hey, we got to order a VOE for you. VOE is simply a verification of employment. There's a bunch of these. There's a VOR, verification of rent. A VOD, verification of deposit into a checking or savings account, as the case may be. You may hear monthly mortgage insurance, or PMI, private mortgage insurance. Again, if you're putting less down, you're going to have mortgage insurance. You may have upfront mortgage insurance. If you're doing an FHA loan, USD loan has upfront fees, upfront mortgage insurance, UFMIP. Upfront mortgage insurance premium. So Like an FHA loan has a fee of 1.75% at the front end of the loan. It's added generally to the loan amount. So that's why a lot of times you see, when you look at an LTV for a property you're buying, you see it, the loan amount is actually a little higher than you expected. Could be from that upfront mortgage insurance. VA funding fee, quite often that will get added to the loan amount. And you'll see a higher loan amount there, especially if you're doing zero down on a VA, the loan amount's going to be higher than the purchase price. Not unusual at all. And I think that'll do it for now. That's a lot to digest. Just a lot of TLAs, a lot of terms you want to get familiar with, so at least you understand them. But for sure, if you have questions, make sure you ask your loan officer, make sure you ask your realtor, make sure you ask the title company or escrow company, whoever you're talking to, just so that you really understand what each thing means and understand all the moving parts of everything that's going on behind the scenes while you're buying a house. If there's any questions I can help answer, you can reach me at 425-214-3458. Happy to help. And we'll talk to you later. Doug DeBruyn, New American Funding.